Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. You only need a handful of mutual funds and or ETFs in order to build a portfolio that can make you incredibly rich. And that's exactly what we're going to be talking about today. I have just a few Vanguard ETFs and or mutual funds that you can use to build your own portfolio and probably invest in these pretty much for life. And the very first one that I want to talk about is the Total US Stock Market Index Fund. Through Vanguard, they have the mutual fund VTSAX and they have the Exchange Traded Fund or ETF VTI. Now, both of these are practically the same thing. It's just that one is a mutual fund and one is a ETF. And that's exactly how I'm going to break down these funds for you today. Each one, I'm going to give you the mutual fund and I'm going to give you the ETF. At the time of when I looked up on the website what these were invested in, they were invested in 4,136 US stocks. Now that can change a little bit daily. There is going to be some turnover of more or less stocks, but that's approximately what you're looking at here. A little over 4,000 stocks. And they're all going to be based in the US. So these are companies that are made in the US. And for the ETF, the expense ratio is just 0.03%. And for the mutual fund version of VTSAX, the expense ratio is 0.04%. So both of them are extremely low and you're practically not paying very much at all in order to invest in the entire United States stock market. Similar to that, except for it might seem a lot different, but even though it's not that much different, is the S&P 500 index. Vanguard offers the mutual fund VFIAX and they offer the ETF version of VOO. Both of these are indexes that invest in the S&P 500, and that is meant to be America's 500 largest publicly traded companies. Now, this might sound extremely different from the total US stock market index, but it's really very similar, and that's because both of them are market cap weighted, which means that the big companies are going to make up the biggest majority of the index, and the smaller companies are going to make up a very small, minuscule amount of the index. And that's just based on how much the companies are valued, their share price times the number of outstanding shares. It's generally around, of course, it's going to fluctuate, but around 80%. These S&P 500 makes up about 80% of the entire total US stock market index. So it's not all that much different. But for this specific fund, VFIAX and VOO, they currently have 507 US stocks. And the reason why it's not a perfect 500 is because there are some of those very large companies that have more than one share of stock. So there are going to be more shares of stock than there are actually 500 companies. So 500 companies have 507 different stocks, basically. So you're still actually only investing technically in 500 different companies. It's going to be the same thing. The same idea is going to be 500 of the America's largest publicly traded companies. And for the expense ratios, it's going to be the same as the total US stock market index, and that is 0.03% for VOO and 0.04% for VFIAX. For fund number 3, we're going to move a little bit away from the United States and we're going to look at the entire world, the entire global economy, and that is the Total World Stock Index. For Vanguard, they offer the mutual fund VTWAX and the ETF of just VT. That represents their Total World Stock Market Index. This index invests in both US companies and in international companies, and it seeks to basically invest in all of the publicly traded companies, like the vast majority of the publicly traded companies in most of the world stock market, most of the global economy. And this can be in developed countries, internationally, and in emerging markets. So it seeks to kind of have pretty much everything. So if you want to invest in this fund, you're basically saying, I want to invest in the global economy. And when I looked the data up on this, it currently invested in 9,350 total stocks from the US and in international stocks. The expense ratio for the ETF was 0.07%, and for the mutual fund version, it is 0.10%. But instead, if you want to choose your allocation between the US and international, you can choose the fourth fund that I have for you today, and that is just simply a total international stock market index. Vanguard offers this as a mutual fund with ticker symbol VTIAX and offers the ETF version of VXUS. And within this total international fund, which only invests in companies that are based outside of the US, we have 7,000 717 international stocks. The ETF version charges an expense ratio of 0.07%, and the mutual fund version charges an expense ratio of 0.11%. Last but not least, we have a fund that is not stocks and instead is bonds. So more specifically, the Total US Bond Fund. Vanguard offers this as a mutual fund with ticker symbol VBTLX and the ETF version as BND. So this fund seeks to actually invest in US bonds. So if you want to invest in this index, you're looking to diversify a little bit away from just stocks. And you're also probably looking to smooth out your portfolio to reduce some of the volatility that comes with investing purely in stocks. The expense ratios are very, very low. For the ETF, it is 0.035%, and for the mutual fund, it is 0.05%. Now let's talk about why these 5 funds are probably ones that you could invest in for life and have really great returns. But before we move on to that, if you like these Vanguard related videos, then please let me know by hitting the like button on this video, okay? It just sends me a signal to know that, hey, you like the kind of content that covers investing and that covers Vanguard, so I can make more of them. But also, if you're just enjoying the video in general, please hit that like button because it really does help me out and I would really appreciate it. But let's get on to why these funds are probably pretty good for you. Well, first off, investing in these funds is very, very simple. And that's probably one of the biggest things that can bring you success, keeping things simple. So with these funds, you can build anywhere from a 1 to 3 fund portfolio very, very easily and probably have great returns over the next few decades. A second great reason is that these funds are very well diversified across thousands of different stocks and thousands of different bonds. So you can have a really well diversified portfolio by just choosing to invest in some of these funds. And then of course we have the extremely low fees, anywhere from 0.03% all the way up to 0.11%, which that range of fees is extremely low. And one of the best ways to increase your investment returns is by keeping your investment fees low. And so all of these funds are going to offer that to you. And then historically, these funds have done very, very well. They have had pretty great returns, depending on what kind of asset mix you're looking for, depending on what kind of asset allocation you're looking for, how much US stocks you're investing in, how much international stocks you choose to invest in. So historically, some pretty good portfolios involving these funds have done historically very well. So those are some great reasons why these kinds of funds are going to be great for us individual investors. Really quick, let me know in the comments below, do you personally invest in any of these Vanguard mutual funds or any of these Vanguard ETFs? If you do invest in some of them, please let me know in the comments below. And if you don't invest in any of them, let me know if you invest in something on a different platform or just like with a different company that's essentially the same thing. I want to know if you think that any of these kinds of funds are good for your portfolio. But speaking of portfolios, let's put together some portfolio examples. So we can use these 5 funds to build anywhere from a 1 to 3 fund portfolio, and we have some pretty good options here. The first portfolio example is going to be the 1 fund portfolio. So if I were going to build a 1 fund portfolio, the ones that I would probably choose is going to be probably either the Total World Stock Market Index Fund or the Total US Stock Market Index Fund. If you just want to follow the global economy, then you can just throw it all into the Total World Stock Market Index Fund and you could follow the gains of whatever the world economy is making and possibly even the losses of whatever the world economy is going to be losing. And alternatively, you could just invest primarily in the United States. There have been many great investors that have recommended that the general public invest just solely in the United States. That's for you to decide, but if you do want to, you can invest 100% in a total US stock market index and you'll probably do pretty darn well. You might even do better than investing internationally, just possibly depending on how these next couple of decades go. Whether or not the US stock market is going to continue to outperform the rest of the world like it has, let's say, in the most recent decades. We have no idea if that's going to happen or not, but by taking on more of that risk by investing primarily in the US, you possibly could continue to see higher gains. So those are the 1 fund portfolio examples. Now the 2 fund portfolio example can either introduce bonds into your portfolio, or they could introduce a mix of international and US stocks, catered to how you want your asset allocation to look between those. So for example, for a 2 fund portfolio, you could have a total world stock market index, and then you can add in US bonds. So that could be your 2 fund portfolio. You could have a total US stock market index and have a total US bond index. So you're still invested 100% in companies that are based in the United States, but you're still investing in thousands of companies and you're still investing in thousands of bonds. And plus, some would argue that investing in the total US stock market index, a lot of the big companies are already globally diversified. And so technically you could argue that you are already internationally diversified because US companies make a significant amount of their profits from overseas. And then a third example, if you wanted to keep a 100% stock portfolio, you could invest in a total US stock market index and a total international stock market index. And then you can keep your allocation differently than what the total world stock market index is. Me personally, I currently right now do 80% US and 20% international. You could do that yourself by choosing a total US stock market index, having 80% of your funds in that fund, and you could have a total international stock market index and having 20% of your funds in that fund. And lastly, we have the 3 fund portfolio examples, which I think is probably the most recommended for most individual investors that are looking to keep their portfolio simple. And the most popular one is going to be a total US stock market index, a total international stock market index, and a total US bond index. So whatever combination of those 3, whatever kind of asset allocation that you want, you can kind of, pick and choose how you allocate between those 3 funds. And then I've also seen that similarly with, instead of having a total US stock market index, we just replace that with the S&P 500. Some people like to invest in the S&P 500 more than they like to invest in a total US stock market index. So that could also be a good 3-fund portfolio, especially let's say if you have a 401k at work where you're investing in and they don't actually offer the total US stock market index. Instead, they only offer the S&P 500. That is a great substitution. It can be a good, at least a temporary substitution that you can always change later. That could also be a pretty good 3-fund portfolio. While I personally think all 5 of these are really great funds that you could possibly invest in for life and have really great returns and grow very, very rich, you have to know actually how to do it, not just what you need to do, but how to do it as well. And that's why if you have not already, you do need to watch another video that I created for you. I created a full guide to investing your way to financial independence. Achieve financial independence through investing. Okay, that video is going to pop up right next to me. Please watch that video if you haven't already. Thank you so much for watching this video. I'm Zach from OnCashFlow.com, and I hope to see you next time.